Morning, everyone. It is 2 minutes past 11. I think there are still some more people joining, but I think we'll just press ahead. So I just want to start by welcoming you all to our Menzies property sector budget update. We're calling it a budget update, but actually, as you'll hear from my colleague Richard shortly, there wasn't a huge amount of content in the budget that specifically affects the property sector. So whilst Richard will cover the bits that are relevant to the sector, we're also going to cover some other topical issues. The other topical issues we're covering, there's a few commercial aspects that some topics we see come up regularly with our property developers and also with our residential buy-to-let landlords. So we're just going to have a quick update on those issues. And we're also going to cover very briefly some succession planning for people that own property. We're going to finish with a Q&A. And just before that, there is going to be a short poll. For the Q&A session, if when we're talking, you think of any questions that you'd like us to address, if you put those questions in the chat box at the bottom of your screen, what we'll do then is we'll pick them up at the end and we will cover those in the Q&A session at the end. So just to go through our panel, for those of you that don't know me, my name's Rebecca and I'm a tax partner on our property sector team. I specialise in business tax, so that's mainly advising companies, but I do cover all sorts of aspects of property tax. And I'm joined today by my colleagues, Amy and Richard. So Amy is a director in our private client team and advises private clients on their property matters. And Richard is a senior tax manager, again, business tax, but he has a very special a specialism in stamp duty land tax, which obviously is very relevant for the property sector. So without further ado, I'm going to hand over to Richard, who's going to give the update on the budget. So thank you, Richard. Over to you.
Thanks, Rebecca. So as Rebecca said, I'm just going to look over some of the main announcements in the budget last week that affect the property and construction sector. There wasn't masses in there. The main one for me anyway was the abolition of multiple dwellings relief. So this was is a relief for acquisitions of more than 2 or more residential properties in a single or series of transactions. And the way this relief worked is you took the total price you were paying for all the properties and you divided by the number of residential properties you were buying, which gave you an average rate or an average price for the properties. And then you paid the SDLT on that average price, and that would generally mean that you would be better off, or the investor buyer purchaser would be better off, especially if they were buying one really expensive property and lots of smaller, cheaper properties. Obviously, that averaging process really reduced that rate of SDLT. Now, what we have as an alternative to that is, and this has always been the rule, where you acquire 6 or more residential properties in a single transaction, that transaction could be treated as a non-residential transaction. So in that situation, you have a top rate of tax, a top rate of stamp duty of 5%. So it's not as generous as the multiple dwellings relief, but it is, it's not too bad. And it's probably not too far from where large-scale investors would have been. I think the people that will really lose out here will be the smaller property investors who are buying 2 or 3 and not buying 6, because they will see their SDLT going up astronomically, because they're potentially paying up to 15% SDLT on if they're buying 2 or 3 properties in a single transaction. So the relief isn't actually abolished until the 1st of June 24, so there is still a little bit of time. Now, there are also transitional rules, so anyone who exchanged contracts on or before budget day will actually still be able to claim the relief beyond the 1st of June, providing there is no variation to those contracts. So it's not completely gone, and if you're in the middle of a transaction, don't panic. I'm sure there is something that can be done. So the other big announcement was the abolition of the privileged furnished holiday lettings regime. So that's going from April 25. Now, for those who don't know, the furnished holiday letting regime is basically like a short-term letting, so more of a kind of Airbnb kind of model as opposed to letting buy-to-lets on short hold tenancies. So you have lots of occupants who stay for a week, 2 weeks, and as long as the property was available for a certain number of days a year, and no one occupied the property for more than a certain number of days, then there were two main benefits. And the first is that you could claim your interest relief in full, which obviously you can't in an ordinary buy-to-let investment. And the second was that on a sale of properties that qualified, you could actually qualify for business asset disposal relief, which means the capital gains tax rate on those properties were reduced to 10%, but that's going from April 25. And then we have three kind of relatively modest kind of bits of positive news. The first one is the reduction in capital gains tax for the disposal of residential property from 6th of April. So at the moment, the top rate of capital gains tax is 28% for residential property, and that's coming down to 24%. And I think the idea is hopefully that will incentivize some people who may be looking to get off of the or out of the residential market to do so, perhaps free up some housing, etc. I mean, it's better than where we were, but it's still not great, I would suggest. And then the last two, as I say, really modest. We have this 2% NIC reduction for employees and self-employed, which will result in a few extra £100 per year, and people being better off. And then last, we have the increase to the VAT threshold. So we've had the VAT threshold's been at around 85,000 now for a number of years, and that's gone up to 90,000. And it's not, as I say, it's fairly modest, but it will help out some of the smaller builders who I know generally try and keep their turnover below the VAT threshold, so they don't have to deal with the admin of doing VAT returns, etc. And also potentially it makes them quite uncompetitive if they suddenly have to start putting 20% on their sales. So that's a kind of a whistle-stop tour through the major budget announcements. I will now pass you back to Rebecca.
Thanks, Richard. So as we said, probably not a huge amount of content in the budget specifically for the property sector, but we did want to chat through some other topical issues. And something that comes up quite regularly with our clients who are sort of residential property developers. In this market, we are noticing that developers are building houses, and then because of uncertainty with interest rates, they're often not able to sell those properties for the price they thought they would, or in some cases, just it's taking a long time to complete that sale process. And we get asked questions of, what happens if in the interim we wait for the market to improve, and in the interim we let these properties out. In some cases that may be just a short-term change of intention to try and get some money in whilst waiting for the property market to improve. But sometimes it can actually go longer, and the developer can actually permanently change their mind and say, do you know what, I'm getting a good rental income stream from this property, I'm not going to sell it anymore, I'm going to keep it for long-term investment. It's really important to note that where there is that change of intention, it can trigger some taxes that perhaps were unexpected. And so I just wanted to run through that today fairly quickly. With this, it's important to note that what I'm talking about here is an actual change of intention. So for people that had always intended to build residential properties to let, and that had been the intention from the outset, that's a completely different prospect. This what we're talking about here is a developer who had every intention to sell the properties, but either at the end of the development has been unable to shift the properties and has changed their mind at that point, or maybe something's happened partway through the development and they've changed their mind partway through. So the biggest problem really where there is this change of intention is in terms of VAT recovery. So where a developer is building new build properties and the intention is to sell those, the sale of new build properties is zero rated, or sorry, new build residential properties is zero rated for VAT purposes. What that means is the developer doesn't need to charge VAT on the sale of the property, but it does mean they're entitled to recover input VAT on the costs incurred in that development. So it can be really tax efficient from a VAT perspective because the recovery of the input VAT helps to keep the build cost low. Unfortunately, if the developer then decides, actually, I'm not going to sell these properties, I'm going to let them instead, letting of residential property is not zero rated, it's exempt. And if it's VAT exempt, it means you don't have that entitlement to recover the input VAT on the costs. So where the model changes, and instead of selling, a developer starts letting property, that can trigger a clawback, potentially of all or some of the input VAT previously recovered. So it can significantly increase the costs of doing that development. There's also potentially a corporation tax hit. That would only apply if the change of intention had become permanent. So if you're just deciding to temporarily let a property to collect some income whilst the property market improves, but you fully intend to sell that property again, maybe once prices improve a bit, you don't need to worry so much about the corporation tax hit in those circumstances, because ultimately your intention hasn't changed. However, if you had decided permanently that you're not going to sell these properties anymore, you're going to keep them, what effectively happens is it triggers a deemed sale of the property. So previously, the developer would have held that property as work in progress in their accounts, but on changing the intention permanently to keep it, the property is it's effectively transferred from work in progress into fixed asset investments. And that appropriation from work in progress to fixed asset investments, it's deemed to take place as a market value transfer, and that the increase in the market value of the property becomes a profit that's chargeable to corporation tax. So you can actually end up paying corporation tax on a profit that isn't actually realised. So you don't have any cash to pay this liability. So what is the solution? Well, there's potentially a partial solution, first of all, for the VAT. So what some developers do is they will set up a new group company or a new company within the group, and they will then sell the residential properties within the group to the other group company. That is still treated as a sale for VAT purposes, so it does still enable the company that did the development to keep the input VAT that they previously reclaimed. Unfortunately, that doesn't solve the corporation tax problem. So when you sell the property over to the new company that is then going to let it, that does trigger a corporation tax charge, and that is regardless of whether the company that is effectively buying or receiving the property in the group, it doesn't matter whether that company's intention is to sell it at some point or whether it is to keep it. It's just going to trigger that charge because there has been a sale. Potentially, it's possible to manage that liability. So it's a case of working out how much that profit is going to be, working out the tax liability, and then looking at when the timing of that tax will be due. If it's a significant profit, so if it's a profit in excess of 1.5 million divided by the number of companies in your group, it may be that tax has to be paid by quarterly instalments. If it's below that limit, then the tax would normally be due 9 months after the company's year end. But taking advice on the extent of the liability and when it will fall due can help you manage the cash flow. If the company that's receiving the property still has the intention that at some point they will sell it, that corporation tax would have hit at some point anyway. So it's kind of just a timing issue. The downside would be if it's a company that intends to hold that property for longer term letting. So if that company is going to hold it as a fixed asset investment, the corporation tax is triggered, and there isn't a way out of that. It's not an acceleration of a tax charge that would normally be due. It's actually crystallizing a tax charge that if you'd actually had the intention to build to let right from the outset and the property had never been held in work in progress, that tax charge would have never been triggered. So it's really important to actually get your intentions right from the outset and to make sure you're treating all your costs of the bills appropriately in the company accounts. There's also potentially an SDLT impact, and I'm just going to pass over to Richard just to cover that angle.
Yeah, absolutely. So I think in the situation that Rebecca's describing here, I'd normally expect SDLT group relief to be available. So the group relief applies to transfers between companies in the same corporate group. There needs to be a 75% relationship between the companies or another company above them. And that's determined by looking at the assets on a winding up, rights to profits and capital. A couple of other points to just mention on this is that there has to be an there is an overarching rule that the transfer can't be part of tax avoidance, which I think this situation certainly isn't that. And the other important factor is that there is a clawback potentially if the purchaser company leaves the group within 3 years. So that's just something to bear in mind. And certainly if you were looking to move properties into to form an investment company and you were looking to sell that off at some point, you might want to factor that in. You'd have to wait for that length of time or sadly pay the tax. But I shall pass you back to Rebecca. Thank you.
Brilliant. Thank you, Richard. If we could just move on to the next slide, please. We sort of covered the immediate tax impact of changing intention and then potentially moving properties to a new group entity. It's also important to think about some of the longer term tax implications. So if you're a property development company and that is your only activity, you don't have any investment properties or other investment assets, you're going to be treated as a trading company for tax purposes. For shareholders in trading companies, there are some really important tax benefits to be aware of. So the first tax benefit that's really important for shareholders of trading companies is the ability to claim business asset disposal relief, which used to be called entrepreneurs relief, when you sell the shares in that company. The business asset disposal relief entitles the shareholder to a 10% CGT rate on the sale of shares. If that relief wasn't available, the normal CGT rate would be 20%. So it actually halves the tax rate. Now, there is a limit on this relief, and that's to your first lifetime limit of 1 million of gains. But, effectively, if you're selling shares in a trading company, up to £1 million of gain is at 10% instead of 20%. So it's saving 100 grand of tax per shareholder. This relief only applies to trading companies or the holding company of a trading group. And for this purpose, when HMRC considers what is trading, a group or a company would probably lose its trading status if more than 20% of its activity was from non-trading activities. So if you've got a property investment portfolio and that gets to be fairly significant, where it's taking up more than 20% of the company's or the group's overall activities, you could potentially be jeopardizing this bad relief potential on selling shares. When looking at this 20% threshold, HMRC look at things in the round. So it's not necessarily just looking at asset values. It looks at the level of activity of your staff that are managing investments versus trading. It would look at income. So where does the group's income come from? Is it more than 20% from, for example, rental income? So really important if you've got a mixed trading and investment company or a mixed trading and investment group to take advice as to whether that trading, the non-trading limit is being exceeded, and are you jeopardizing your bad relief? Another really important relief for shareholders is business relief, and this can provide 100% relief from inheritance tax if a shareholder dies whilst holding the shares. Again, this only applies to shares held in trading companies. It's a slightly different measure of what is trading and non-trading for this test. So for the inheritance tax business relief, it's generally 50% is the measure, or wholly or mainly. So again, if you've got a sort of a mixed investment and trading group or company, it's really important to get some advice as to whether you're kind of ticking the boxes for getting both of those reliefs. Obviously, losing inheritance tax relief can be it can be a significant cost if somebody dies holding shares that they think qualify, but actually turns out they don't. A slight complication with the business relief as well is even though a company as a whole may qualify for relief, or a group as a whole, HMRC does have the power to look through, and there may be some things called accepted assets within a group that are investment assets that are kind of almost hidden within what would be a trading group. So it's important to take advice on whether your group as a whole would get you this business relief, and whether there are any assets within the group that would fail to get the relief. It is possible, having sort of drawn your attention to these two reliefs that only apply to trading companies, it is possible to manage risk over time. So if you have a group that has a mixture of trading and investment activities, and you're getting to the point where you think that the investment activity is becoming so significant that it's jeopardizing these trading reliefs, you could look to do something called a demerger, which can separate the two parts of the business, the investment part and the trading part, into two separate groups. That would still potentially allow the release to apply to the trading group that is separated out. Obviously, you wouldn't achieve it on the investment part. But if planned correctly, a demerger can be done to split the activities in two without triggering any tax charges for the companies in the group or for the shareholders. So it's a really important planning tool, and it's something we do with a lot of clients who are looking to maintain the reliefs on trading parts of the business. And it could also be used if you've got a trading part that you want to sell off, but you don't want to sell valuable investment assets. So if that's something that is of interest, please get in touch. Demergers they're quite complicated things to plan, but can be very valuable if structured correctly. And next slide, please. So just moving on, totally different topic, totally different sector of the property market. We obviously do a lot of work with buy-to-let landlords who hold residential properties in their own names. As many of you may be aware, something called Section 24 came in, back in 2016, I think. And the impact of this was it meant landlords who owned residential properties in their own personal names were restricted on the amount of tax relief they could claim in respect to their mortgage borrowing costs or other finance costs. Since the rules were introduced, there's been a lot of talk about landlords incorporating their property portfolios. And what this is where the landlords set up a limited company and transfer the property portfolio into the company as kind of as a going concern. So the rental activity is then carried on in a company. I think it's important to note when the Section 24 changes came in, the corporation tax rate at the time was about 19%, and it was expected then that it would drop further to 17%. So the idea of running a property portfolio in a limited company was quite attractive, because we thought the corporation tax rates were going to be low, but also because companies were still entitled to claim a deduction for interest costs on mortgage borrowings. So those two things together made incorporation look like quite an attractive prospect. Obviously, since then, unfortunately, the corporation tax rate has gone up to 25% with effect from April last year. So that has started to erode some of the tax efficiency of operating a rental property portfolio in a limited company. It's probably more sensible if you don't have an existing property portfolio and you're starting to build one up, to set up a limited company to buy the properties from the outset. But trying to get an existing property portfolio into a company is quite tricky. And I just wanted to talk about that a bit to debunk some of the kind of myths out there. So the starting point when trying to work out if you should incorporate an existing portfolio is really to look at whether it is going to be tax efficient. As I said, the corporation tax rate now is 25%, which means you're going to pay 25% on the profit. An important point to note is once the property is in a company, that profit belongs to the company. It no longer belongs to the landlord. So if the landlord needs to extract any of that profit for their own living, to supplement their own income, they then have to extract that profit either by way of a salary or perhaps dividends. More usually it's a mixture of both. But that profit extraction is going to trigger income tax charges for the landlord. So you've almost got a doubling up of tax charges on the same profit. you have corporation tax in the company, but then the landlord is going to pay income tax either on salary or dividends when he takes that profit out. Depending on the amount of profit we're talking about and the amount that the landlord needs to extract to live off, it isn't always actually more tax efficient to have your property portfolio in a company. Sometimes it is actually marginally better off to leave things as they are. So really important you get that review done first. The other thing to know, even if it is, you know, even if you end up saving a bit of tax every year by doing an incorporation, you have to weigh up the actual costs, the upfront costs of doing that transaction, and it isn't cheap. So the first thing is trying to sort out the financing on the portfolio. I know Property 118 have been saying you don't need to tell the landlord, you just transfer the properties over, and you know, the landlord, the mortgage provider doesn't need to know. That really isn't the case. There's a lot of scrutiny on the Property 118 structure at the moment, and it has been quite clearly ruled that is mortgage fraud. So you're going to end up in a lot of trouble if you transfer the properties and don't tell the landlord, the mortgage provider. And to do it properly, unfortunately, isn't cheap. So you have to get your mortgage company to agree that they will novate the mortgages over to the company. And that's sort of a legal process where a lender will allow another borrower to kind of step in and fill the shoes of the original borrower. Most mortgage companies will see that as being usually an early termination of existing mortgages, which trigger early redemption charges. They then want to charge sort of facilitation or admin fees for agreeing to the novation and for facilitating it. And quite often, once the mortgage is transferred over to the company, they then want to increase the interest charges. So all in all, that can end up being very expensive. You have solicitors' fees on properly conveyancing all the property over as well. And then you've got obviously the tax planning fees. So you can have really large upfront costs. And if you're not making significant savings in the annual tax, it may not actually be worth doing it. The final thing to note is if it's not planned properly and if you don't meet the conditions for claiming relief, you could end up paying capital gains tax and stamp duty land tax on the transfer as well. I'm not going to go into the mechanics of claiming these reliefs today. That could be a webinar in itself, but it's really important to take advice and make sure you do meet all the qualifying criteria for claiming those reliefs, because if you don't, CGT and SDLT on a extensive property portfolio would be very, very expensive, and once the transaction is done, you can't unwind it. So not something you want to trigger without being fully aware of the facts. In terms of solutions then for landlords who maybe don't meet the criteria for incorporating, or it isn't tax efficient, but perhaps they're actually struggling to afford to run their portfolio. I'm hearing this from landlords a lot now, where because of interest rate charges, you know, their costs are going up, but they can't claim the tax relief. We've also got cases with tenants in arrears. Unfortunately, there isn't really a magic bullet to this, or at least not anymore. So there were landlords that were switching to the furnished holiday let model. So they were sort of evicting or getting rid of their sort of longer term tenants, and actually marketing properties on things like Airbnb, trying to get sort of short-term tenants who stay for a couple of weeks. And they were making sure they qualified for furnished holiday letting, because that meant they could get a deduction for their mortgage costs. Unfortunately, as Richard said earlier, that regime is being abolished from next year. So this is not going to be a viable solution for private landlords anymore. Unfortunately, it really is the case of just looking at property portfolios now. And if you don't qualify, you know, if the incorporation is not going to work, just looking at your property portfolio and deciding whether it's time to offload properties that just aren't making commercial sense. Not the best news, but unfortunately, there isn't really a magic bullet to this solution. The final thing I'd say is just be aware of schemes. There's a lot of accountancy firms or, you know, boutique firms promoting various schemes for landlords that help them get over, supposedly help them get over Section 24, the less tax for landlord scheme, which was quite popular, has been ruled by HMRC to be tax avoidance. So please don't get caught out and take proper advice. That was it from me. I'm going to hand over to Amy now, who hopefully has some better news for you. She's going to be looking at succession planning for property. So Amy, over to you.
Thanks, Rebecca, and morning, everybody. As Rebecca said, my name's Amy. I'm a private client director here at Menzies. I wanted to talk to you about succession planning, but obviously that's a massive subject in itself. So I've picked out some property related topics to run through. So what I thought we'd cover is why you need to consider inheritance tax and succession planning, the possible planning for property companies and properties held personally. The family home tends to be one of people's most valuable assets, so we'll have a look at that and how that interacts with gifts and reservation of benefit. So why succession planning? And in my opinion, the most important reason is to protect your wealth and ultimately ensure that the assets that you have end up where you want them to end up. The only way you can do that at the moment is to make sure you have an up-to-date will that reflects your current wishes. We see so many occasions where property or other assets are passed to a spouse. Then unfortunately there's a remarriage, and then ultimately the property or asset can pass down to where it's not, where it wasn't intended or not wanted. So it really is important, and that's a really important takeaway point from today, is to get your will updated. The other area is obviously to reduce inheritance tax. Inheritance tax is a tax that's paid on your total estate. There are some reliefs available, but unfortunately they don't tend to cover, or they're not attractive for property. So everyone does have a nil rate band, which is currently 325,000. That can be transferred to your spouse on death. So as a couple, you have 650,000 to offset against your estate. Anything above that is chargeable to 40%. And given that you've paid tax during your lifetime, it's quite a penal tax. So anything you can do to reduce that is worth considering during your lifetime. Next slide, please, Lucy. There is another relief, or it's a band, a residential nil rate band, which you may have heard of in the media, that was introduced in 2017. It's worth 175,000 each, so that's 350,000 per couple. It's available when a residential property passes to lineal descendants, and by that they mean children, stepchildren. That does include adopted and foster children, which is good. But the problem with this residential nil rate band is it is tapered away when the estate value goes over 2 million. So if you have an estate value around that mark, around the 2 million mark, it's really worth looking if you can get it down below there, because this relief in its own right can save inheritance tax of 140,000, which is quite a considerable sum. Next slide, please, Lucy. So I wanted to look at some property specific solutions to help reduce inheritance tax, and we'll start by looking at property investment companies. And as Rebecca touched on earlier, the impact of the interest restriction and lower corporation tax rates mean that more properties are being purchased in companies. But property investment companies do not qualify for business relief, unlike certain trading companies, as Rebecca went through earlier. So property values are likely to grow over time. We've seen that in the past. This will in turn increase the share value, and it will increase exposure to inheritance tax because those shares will form part of the estate. Next slide, please, Lucy. Thank you. One option that you do have is to create a separate, or look at creating separate share classes. So values at the moment are relatively low post the pandemic, so you do have an option to lock in the current value. And the key to this is to create new growth shares. You may have seen a lot about this in the press. And they are growth shares in the investment company, and it's these shares that you gift to the children. So they're entitled to the growth of the portfolio over time. And that growth is then taken out of your estate for inheritance tax purposes, while you get to retain the income and the voting rights, so the control of the company. Next slide, please, Lucy. Gifting the shares is considered a potentially acceptable transfer for inheritance tax purposes, which would mean you would have to survive the 7 years for it to fall outside of your estate, and it is a deemed disposal at market value for capital gains tax purposes. But usually the value is relatively low, and that's arguably they don't have a current value or a present value, because it's all linked to that hope value for the future growth. So I thought it'd be helpful just to run through an example with you. So if parents hold 100% of an investment company that was worth 6 million pre the pandemic, and the current value is 4 million, the plan is that it's likely to recover, but it's going to take a bit of time. What you could do is have shares held by the parents reclassified as A and B shares. The A shares are held by the parents with the rights to capital capped at, say, 5 million. The B shares are then gifted to the children. They have no right to capital until that growth exceeds the 5 million. And after that point, they receive anything above and beyond the 5 million. So the B shares have no voting rights, so the parents retain the control. The value is set higher than the market value, meaning that the hope value of the growth shares is relatively low, and the lack of voting rights also suppresses the value. So if over time the value of the property returns to the 6 million, that has saved in its own IHT of 400,000, and that would increase as the values increased over time. As with everything, there are some risks to flag. So when you're making outright gifts to children, you have to factor in commercial risks. And one of those things that we see day to day are the risks of divorce, as the statistics, unfortunately, are increasing. So you may want to factor in some other planning there as well. So consider things like trusts and making sure that the articles of the company are up to date. So there's a plan in any eventuality what would happen to the shares. So property held personally, many buy-to-let landlords still hold property personally. They may have explored the option of moving it over to a company, as Rebecca was talking about, and looking at the incorporation release. However, in a lot of cases, you'd be facing a stamp duty and capital gains tax charge. So a lot of people are sitting on large capital gains tax exposures. If they were to gift the property, you'd be hit by the CGT, and you'd also have a potentially exempt transfer for inheritance tax purposes. So that would mean you'd have to survive 7 years from making the gift. The other thing to factor in with making a gift is you'd also lose that income, which you may rely on, so the rental income. If you sell the property, again, you have a capital gains tax liability, but you also bring the proceeds into your estate. So that if something would happen to you and you were to die, you'd pay inheritance tax on the cash value as well. So some things to think about there are death payments. Although it's not a very nice thing to think about, assets can be transferred between husband and wife without incurring any tax liabilities. We often see that in lifetime if we're doing some income tax planning to use basic rate bands, for example. But assets, if a spouse were to become terminally ill, it can be beneficial to transfer the property into the poorly spouse's name. And the reason for that is because assets are revalued to market value at date of death. So that would mean that the surviving spouse could gift without incurring any capital gains tax liability on the basis everything was passing to them. Another thing to think about would be the use of life trusts. They can be really tax efficient, and you've probably heard of their use, especially for school fees, for example. So it's possible to move a property up to a value of 650,000 jointly, if you've not made any gifts in the previous 7 years, into a trust. The income is then paid into the trust and can be used to pay school fees, for example, or paid out to beneficiaries. And assuming they've got their allowances available, they can reclaim any tax that's paid, making it very tax efficient. Other things to think about are investments that you may have sitting at losses. You might want to crystallise those and offset those against any gains. There's also some tax efficient investments that you can make, such as EISs, which enable you to defer capital gains tax. So if you wanted to spread your risk portfolio away from property into other sorts of investments, that might be something to explore as well. Next slide, please, Lucy. So the family home, planning with the family home is not easy. That's really the message to take away here. There's masses of case law. There's been loads of schemes in the past, and essentially you cannot give away an asset and retain benefit. So you can't give away your home and remain living in there. The donor has not completely relinquished control or benefit over the asset. HMRC consider it to be a failed gift, and the value would actually stay in your estate for IHT purposes. Thought went into this, and a lot of people started giving cash to children for them to buy a house, them to live in. Unfortunately, that doesn't work either. There's legislation to prevent that, and that's called pre-owned assets tax. So you are caught either way. But some things to think about at the family home. Lucy, if you move to the next slide, please. If you wanted to gift the property, it would need to be more on a commercial basis. So you'd have to continue or pay a market rent for living there. So you'd have to have the income to support that. With the property and how expensive it is at the moment, a lot of people are considering joint ownership. So they have children living with them, or they live jointly, and it's much easier to give part of a property in that situation and avoid the gift with reservation of benefit and pre-owned assets tax. So that's something to be aware of. We're seeing that equity release and loans have a place as well. They can be quite expensive, but you can invest the money and generate an income. So depending on the circumstances, it can work. It can work relatively well. If possible as well, I know I touched on it earlier, but try and review your estate value, and if possible, reserve the residential nil rate band, because that's worth quite a considerable sum. Property generally, like the main home, when you're married, is held in joint tenancy. So what that means is when you pass away, it automatically passes to the other spouse. It is possible to change that and sever the joint tenancy and change it to tenants in common. And then you can specify in your will where you want a share of the property to go to. You could either leave it in trust or to children directly. There are other benefits to doing that, and it can help with care home fees, for example. So that's another thing to bear in mind. Lastly, I think I've put on there is insurance, and that's really because property can be quite hard to sell, and there's a lot of pressure on the estate to pay inheritance tax. So that really does help the beneficiaries after someone has passed away to fund any inheritance tax liability. So there's some high level things to think about. What I'll do now is I'll pass you back to Rebecca, who will wrap things up and take any questions. Thank you.
Thanks, Amy. I'm sure that's given everyone lots to think about. Before we move on to the Q&A, we're just going to do a really short poll, and that's just to see if anyone wants any follow-up really on any of the topics we've discussed. So the poll is up there. If you do want a follow-up chat on any of the topics, please put in your answers. We're also going to be taking questions from the audience. At the start, I said if you've got any questions, please pop them in the chat box at the bottom. I don't see any questions in there at the moment, but you've got a few minutes if you want to put something in. Yeah, please go for that. I'll just be quiet now whilst people are filling in the poll. So, Richard, that might be a question for you that's popped up.
Yeah, I'm not sure that joint ownership will still mean children need to pay stamp duty when they move on and buy themselves. I'm not sure I really understand the question.
I suppose is that first time buyers relief maybe?
Yeah, it might be. Yeah, so I think if they have owned an interest in a residential property, then they wouldn't be entitled to first time buyer relief. So if you were to transfer a property to a son or a daughter, then yes, that would mean they would almost certainly lose out on first time buyer relief. Oh yeah, and growth shares, that's an interesting one.
Yeah, I mean, technically, how do you create growth shares? I mean, it's all to do with the company's articles of association. So you'd have to get the company articles of association amended to allow for a new class of growth shares to be created. That is something that we can assist with, or in conjunction with lawyers. You just need to decide what rights you want over the shares, and then you amend the company's articles to include those rights. I suppose the other point to note there is it would be necessary to get a formal valuation done, though, of the growth shares. So typically you'd look at what the value of the company as a whole is today, and then you would set the growth shares to participate in capital once a certain hurdle had been reached, and that hurdle is normally set above what the value of the company is today, because if they could start participating in value straight away, they would be those growth shares would be more valuable. The higher you set that hurdle, the lower the value of the growth shares will be, but you do need that formal valuation done, because for the, let's assume it's parents that want to give growth shares to their children, unfortunately it's still a disposal. If those growth shares are coming out of a parent shareholding, it is still a disposal event for capital gains tax purposes based on the market value of those shares. So really important to get formal valuation done. You can play around with the values to see if we increase the hurdle to a certain level, what impact does that have on the value of those growth shares? And you can get it to a point where you're kind of comfortable with what the value is. But yeah, not something to just have a go at doing yourselves without taking advice on the valuation and on the company articles.
Yeah, so I see there's another question here on valuation. So in probate valuations, does the valuation have to be a chartered surveyor, i.e. RICS surveyor, or again, a estate agent provide this service? I mean, I'm quite happy to answer that one. I think it probably depends. So I think for HMRC, you need to demonstrate that you've taken reasonable care. And so I think if you had an asset or property that you were valuing and it was potentially has a lower value, then I'm not sure that you necessarily need to go as far as getting a RICS valuer involved, because obviously the amounts involved may not be that great. I generally say to people for anything that's not really valuable, I would say, well, you might want to get a couple of estate agents, perhaps just look on Rightmove, Zoopla, something like that. If you can get different sources, and then you just kind of take almost like an average value, I think seems to be a reasonable thing. And I think if you've got a very expensive property, then perhaps you might need to get a RICS valuer, or if it's quite complicated. I don't know if you guys have any thoughts on that.
No, I'd agree with you, Richard. Yeah, often it depends if it's likely to be contentious or if it's likely to be argued, then you might want to
get
professional valuation.
You can get that sometimes, can't you, if there is particular rights or something that may impinge on that value and it's a little bit contentious. I agree, in which case you might want to do that. Can you use employer pension contributions in property companies as more tax efficient?
Yes, you can, absolutely. And it really is tax efficient. So it's an interesting question. I work with quite a lot of property investors, and they tend to really like property and not be so interested in pensions. But actually, if you have a company, it doesn't matter that it's running an investment portfolio or whether it's trading. It can make employer pension contributions to its employees and directors. And the company, as long as that pension contribution is sort of a reasonable commercial level of remuneration for the person who the contribution is for, it would be deductible for corporation tax purposes, and then it isn't taxable on the person that the contribution is for. Obviously, there's sort of limits that you need to be aware of with pension contributions. I think the standard now is £60,000 per annum, but that can be tapered if your income exceeds certain thresholds. Not my specialist area, I have to say, on pension contributions, but we've got colleagues that we can put you in touch with if anyone wants advice on making pension contributions from a property company, because it really is a tax efficient thing to do.
Okay, another question: when growth shares are given away, can the original non-growth shares belonging to the parent be given to the children at a later date and then live 7 years to avoid IHT?
I think yes is the answer. Obviously, you can gift shares. It's all down to valuation again. So if the parents are holding growth shares that perhaps they've held for a while, you'd need to get those growth shares valued to see what their current value is, because it may be those growth shares have reached the hurdle and they're already participating in value. If that is the case, then obviously those growth shares are going to have value on being gifted. So it's just a question of getting the valuation done. What is the valuation of the shares the parents hold? And what would the capital gains tax impact be if they were to gift those shares away? But yes, in theory, yes, it's possible. Not sure if we've got any more questions coming in now. We have kind of gone over our time, actually. So what I would say, if there's any follow-up questions, our contact details are going to be circulated following this. So we'd be happy to have follow-up emails, correspondence, calls with anyone. So yeah, any further questions, please let us know. You've got the details of our property team panel in front of you there. All our details will be on the website as well, so please feel free to reach out to any of us. Other than that, thank you all for attending. We hope you've really enjoyed today, and yeah, we look forward maybe to talking to some of you about your property issues. Thank you.